What's going on, everybody? What's going on? Welcome to Stock Trades. Holy freaking moly. The whole market is like literally down right now, right? Is it still down? Let me double check. I haven't checked because all I see is green, right? Because Clover is doing well. Who the hell would have thought that, right? Someone talking crap about me selling Berkshire Hathaway. Man, get the hell out of here. You see this big fat C? Why don't you go shove it up your... What's going on, everybody? What's going on? All right. So there's a lot to talk about. My head's about to explode. I don't know where to start. We got about 9 minutes before things, come through. So let's just first, start with the stock price. So yeah, it's up 12% today, and then another 2%. It shot up to like $1.96 or $7. I think it was $1.97 in the after hours. We're up 95% year to date. If you add a little bit of that after hour jump, even more, it's looking pretty good. Also, Palantir reported for folks that also are dueling. Palantir, it's up 15%. It actually went up as high as $29, $28. So, so there's that. Let's go ahead and just look at the comments real quick. This is a live. We're about to hear what Andrew Toy has to say. I got 5 years to get 30. Let's go. 12% is huge. Glad I reloaded. Oh yeah, I definitely reloaded. Insurance MCR is just like literally like what in the world? I've never seen it this low. Al, I need you too. Earnings are out. This looks pretty good to me. SOB after 3 years, they did it. Let's effing go. Wet blanket. How can we find earnings link? Don't worry, we have it here. Number of insured decreased. We knew that, right? Because of the trying to get to that profitability, right? And now it's about retention. Well, they'll probably talk about that, but this is nothing new, my friend. Decrease in insurance members in a good time though. We've seen this. This is not. If you look at the prior quarters and analyze that, we've seen that trend. Everything else looks good. Quality over quantity. Boom. Increased cash burn. Could be added cost running SaaS. Maybe. We'll see. There wasn't no SaaS in the discussion of the earnings here. So we'll talk about that. 7.2 million net income. So we'll talk about that. The moon seems to close. Let's try Mars or Jupiter. Yeah, man. How about Uranus? I'm just kidding. All right. Hopefully SaaS becomes a bigger focus in the future through contracting. Absolutely. Yes, TSS. Very, very good. We're going to talk about this positive net income in terms of GAAP, which is two accounting principles. Okay, so let's see. I always say 496, but yeah, pretty much good job. But whoever doesn't buy Clover shares will be missing the moon trip. Yeah, I don't know, Ken. Are you alive, Ken? You got your opportunity, bro. What's going on? If they become SaaS, it would seem logical. It'd be nice so they don't have to compete against the other Medicare Advantage companies, but they're pulling out. It seems like it's a good opportunity to do both. 5 minutes before the close, about 1 million shares. Let's go. I congratulate the owners of Clover shares. Me too, Waleed. Me too. Yes. Absolutely. So just very quickly, we did an analysis here. I just posted this a couple minutes ago. I looked at the revenue, net income, free cash flow, look at the net income revenue ratio and the free cash flow revenue ratio. Folks that don't understand this, it's part of our Mastering Stock Market course. We teach this stuff. You can take advantage. Coupon code link down below, $1,000 off. Take advantage. It will be expiring soon. Overall, we did all of this from 2019, 2020, 2021. And we used a net income to revenue ratio of around 3 to 4.3% based off of Humana. And we did the calculation and we found an estimation of revenue of 1.337 billion, but that's still below their 1.35 to 3.75 billion, meaning that more of their revenue goes to net income from the adjusted EBITDA side, showing me that this company is better at managing its dollar bills to profitability better than Humana, which makes sense because its MCR is like near the 70%. So we'll talk about this. Folks that are wanting a deeper dive, it'll be in our stock terminal and mastering. All right. So is the report out yet? We're looking good. Yes, it is. Yep. Clove to the moon. Okay. Look at all the comments here. Everyone's excited. I'm excited too. You check link, Mike, etc. It should be good. It should be good. Ken, where's Ken? Al, how is everyone doing? What's going on? What waiting for? Things are certainly escalated. Al, stock trades in the house with some big fat. Just kidding. Okay, so put some Snoop Dogg in that one. All right, so another beat. Let's go. Another raise. Heck, the market. Yeah, I mean, who would have thought that, right? Who would have thought that? That was a crazy move today. Crazy move. Yes, I definitely did. Let's go. Al, stock trades. Oh my God, dropping drems. He has extra monitors. No. I'm not in the OI room. I would never do that. That would be terrible. No, never. Ken totally had his chance to buy. Hopefully he did. Price target for tomorrow. We'll see. Oh yeah, we're going to do an intrinsic value calculation. It's just the time. Yeah, it's exactly nothing burger. Here I am about the dip. All right, good. So we got through all the comments. So very quickly here, let's turn to let's go to Clove here. Let's go to the Clover channel. I can't find it. There it is. Let's go back up. Let's go back up here. There it is. Okay. So this is actually really huge, ladies and gentlemen. All right. Let's go ahead and make it bigger. It grew 11. So the total revenue grew 11%. We're going to do an intrinsic value calculation. Yes, this does shoot up the price target. Yes, this does increase the price target. The fundamentals are changing. All right, here's a big one. GAAP net income. GAAP net income. So we achieved a GAAP net income of 7.2 million in Q2 2024 compared to a GAAP net loss of 28 million in Q2 of 2023, marking the company's first quarter of positive GAAP net income as a public company. Remember, guys, Wall Street doesn't like to come in until that fourth year full range of profitability, usually by the third or fourth. That's a big freaking deal. That's not even freaking SaaS involvement. That's a big deal. We are on the right track. Whoever tells you Clove is terrible, they're stupid. They're stupid. Okay? Chamath, I know you're listening to this. Okay? I know you're watching this, bro. I know, right? This is like simple shit here, right? This guy is going to have to come in. If he doesn't, it'll be what a failure, right? Buy high, sell low, right? Social capital, right? Come on now. All right, so he's going to come back in. So adjusted EBITDA. Well, first off, we should thank him for making this public. So I don't like to. I like to mess with him, but I do like him, right? He smart guy. All right. Anywho, so adjusted EBITDA, 36.2 million Q2 from 9 million. So we pretty much almost 3x'd our 2 to 3x'd our adjusted EBITDA. Insurance revenue is growing 11%, like we said. The MCR is 71% compared to 77%. So you can see that the Clover Assistance, it's reducing its MCR even crazy, right? It's crazy. We got a high revenue now. We can take the average. We'll just take the high part. The adjusted EBITDA is around 50 to 65. I did 57.5 million on the calculation I showed you in comparison to benchmark of Humana. The increase in 3 to 3.5 stars is going to help with them being profitable in the future. And then the emphasis on Clover Assistant technology, integrated care management platforms to empower physicians. So we're going to see what happens here. Okay. So there it is. So that's pretty much a summary of earnings. They're going to go ahead and do it again. And let's look at the call real quick to make sure it started. Nope, call hasn't started yet. So I guess what we can do right now, might as well, let's open up our mastering. Again, if people want to have access to this, you can use our partners at a firm to finance this. Take advantage of this. This is a big deal, guys. Lifetime access to data. And you can see, when I say how to find a 10-bagger, it's very clear that's what we do, right? We're the only ones calling this out, and the mathematical calculations no one talks about. And here we are giving it at the most craziest discount with data. So take advantage. Okay. We're trying to build a community here. So here's the intrinsic value light mode, right? So let's go ahead and just drop their biggest revenue, which is 3 point something, 3.75. So so it's just 1375. Jesus Christ. We're going to do 0.05, which is the lower end benchmark of how you estimate a company. That's around 68.75 estimation free cash flow. We're going to say 496, the outstanding shares. We're going to go up 11%. We're going to go 10 years into the future, discount about a 10 to 15% discount rate, 68.75. By doing this, the numbers change. Now the bear case is 190, which is where we're trading at. The base case is 247, and the bull case is 339. Okay, so that's near correction territory, right? So here's the thing, though. If they're anything like Humana, then we could do around 7% or even 0.07%. I think they're better, right? By doing that, you then go ahead and do, just remember, I'm just going to take a screenshot here so we remember. And I'm just going to, so I don't like, it's just hard, okay? It's hard. Let's go ahead and do that. Okay, earnings call started. We'll talk about this later. Hold on.
Discuss the company's second quarter 2024 results.
Please let me know if you hear it.
Clover Health Chief Executive Officer and Peter Kuipers, the company's Chief Financial Officer. You can find today's press release and the accompanying supplemental slides in the Investor Events and Presentation sections of our website at investors.cloverhealth.com. This webcast is being recorded and a replay will be available in the Investor Relations section of the Clover Health website. I'd also like to caution you that we may make forward-looking statements during today's call that are subject to risks and uncertainties, including expectations about future performance. Factors that may cause actual results to differ materially from expectations are detailed in our SEC filings, including in the Risk Factors section of our most recent annual report on Form 10-K and other SEC filings. Information about non-GAAP financial measures referenced, including a reconciliation of those measures to GAAP measures, can be found in the earnings materials available on our website. With that, I'll now turn the call over to Andrew.
Thank you, Ryan, and thanks to everyone joining our call. Today, we're very pleased to report another set of strong financial results, as well as improved full-year guidance, driven by meaningful profitability from our core insurance plan operations. Underlying these strong results is our Assistant Care platform that enables physicians to identify and manage chronic disease earlier. We believe that this focus improves outcomes for our members, improves total cost of care, and therefore drives our overall financial momentum. Ultimately, that is our goal. At Clover, we develop AI and data-driven technology that is differentiated at managing the clinical outcomes and total cost of care for people with chronic diseases. We believe our financial results demonstrate that our model is working with physicians in our own MA plan. Next, we intend to bring our approach via our counterparts offering to physicians who serve other plans as well. On that note, let me begin with some high-level takeaways from our second quarter performance. First, we achieved meaningful profitability this quarter, highlighted by our increasing adjusted EBITDA, as well as positive net income for the first time as a public company. We're very proud to have achieved this milestone. Given these results, we fully expect to deliver profitability this year on an adjusted EBITDA basis and are happy to update our full-year guidance to reflect this strong performance, which Peter will walk you through later in the call. Second, we've again delivered double-digit top-line revenue growth, with further margin improvement in our core insurance offering. Our impressive Medicare Advantage performance is driving our ability to deliver consistent, meaningful, adjusted EBITDA profitability this year. Third, our performance improves upon our already healthy balance sheet, allowing us to operate from a position of strength. We expect to be able to self-fund meaningful growth in the next phase of our business. Lastly, our strong first half results continue to highlight our unique ability to operate a profitable Medicare Advantage plan almost entirely on a PPO chassis. Unlike other plans that rely on narrowing their networks within an HMO to funnel patients to specific doctors, our approach is fundamentally different and allows us to meet the needs of more of the total addressable market. Clover Assistant's proprietary and patented technology allows us to work with any doctor, improving both their clinical outcomes and total cost of care. This capability is crucial for a PPO model. Our vision is to build physician enablement technology that brings great healthcare to all Medicare beneficiaries. This is precisely why our strategy is anchored on wide network PPOs. Put simply, most people want the freedom to choose their own doctors, not have their insurance plans pick their doctors for them. In contrast, the challenge for the broader industry is that traditional HMO cost management frameworks are not easily executed within PPOs, as there is less network control. Plans used to selecting doctors definitionally cannot rely on that selective network narrowing to drive value-based results in the PPO. This is why we expect other managed care organizations to continue to struggle to balance consumer preference with managing cost pressures. For Clover, we aim to solve this problem by managing quality not by network narrowing, but by equipping physicians with our proven AI-powered software platform to better manage total cost of care and improve clinical outcomes. We do this through a focus on identifying and managing chronic diseases as early as possible. Coupled with Clover Home Care's high-touch clinical capabilities, we believe that our differentiated care model creates a sustainable growth moat in our business and uniquely positions us for success despite broader industry challenges from regulatory changes and shifting consumer preferences. Most importantly, with CA, we are constantly learning from physician interactions and improving to drive better clinical results. Since this last quarter, we're very excited about our technology innovation, featuring several capabilities we've developed. This includes clinical enhancements around heart disease severity and progression to better help physicians identify and manage CHF. We're also streamlining clinician workflows around care gap closure to help them quickly and easily leverage the assistant's access to robust data sources beyond what's available in their EHR. And finally, AI and LLMs allow for quick prototyping and implementation of features like ambient scribing and document summarization that allow us to quickly iterate and deploy features focused on physician workflow and quality of life. With our continued investment in assistant platform development, we believe that we will continue our momentum in our overall MA business as we both focus on generating sustainable, meaningful profitability and returning to top-line membership growth. It's also important to note that we expect to drive meaningful adjusted EBITDA profitability this year from our insurance plan alone. We're making great progress in building out our counterpart offering, and any future financial impact will be additive, but is not yet considered in our guidance. That said, since launching this offering, we have continued to receive strong market interest for our platform, with more potential partnerships in the works. We believe we have a robust pipeline and unique product market fit in a broader MA market that has cited utilization issues and other headwinds over the past year. To this point, the strong MA results in our own plans is a key differentiated advantage that validates our pitch to third-party customers. My strong belief is that we've kickstarted a unique and powerful virtuous cycle, with our Clover insurance offering leveraging our technology to drive quality. That, in turn, should drive better results on our internal book of business, which then serves as validation to third-party customers for Counterpart. Each piece is both complementary and interconnected and builds upon the other. We're continuing to build out this SaaS and tech-enabled services offering, and we plan to share more specific financial guidance and expectations at a later date. Before handing it to Peter for the financial update, I'll touch on how we are thinking about MA plan growth. As a reminder, our focus during 2024 has been on retention and margin improvement in our returning member cohorts. We're executing against this, and our first half results strongly position us to deliver upon these goals for the full year. For our 2025 growth strategy and bids, we're holding off on sharing specific details until more industry and competitor information is available. That said, CMS's recent recalculation of our PPO star rating up to 3.5 stars has resulted in an exciting shift in our go-forward approach, as we now have more flexibility to reinvest in plan benefit design to help drive growth. It's also important to note that we were the only plan in our primary markets to get a star rating increase from this recalculation. Our intent next year is to continue to grow top-line insurance revenues in excess of the market, while simultaneously improving our underlying cohort economics to drive increased long-term profitability. Ultimately, we'll have to see how the competitive positioning plays out, but we feel very good about our pricing and how we've positioned our business next year to build on our 2024 performance and momentum. With that, I will now pass it over to Peter.
Thank you, Andrew. Before diving into our results, I would like to share a few quick notes on the company from my perspective as I've settled into my role. Overall, I'm very pleased to join Clover at such an exciting time, and I'm continually impressed by the industry-leading AI-powered technology, talent, and general business momentum of the company. I believe that our business is steadily improving its profitability profile, and I am excited to be part of a company that has created a unique framework to improve the lives of people with chronic diseases, while simultaneously building an attractive and scalable financial opportunity. I'm also excited by the opportunity to expand the use of our proven technology through our Counterpart Health SaaS and tech-enabled services offering. Getting back into our earnings content, I will first cover the second quarter financial highlights and then review our improved guidance for full year 2024. Clover's core fundamentals are strong. As Andrew mentioned, the second quarter was Clover's first positive GAAP net income from continuing operations quarter as a public company. Second quarter GAAP net income was a profit of $7 million, as compared to a GAAP net loss of $29 million in the second quarter of last year. Similarly, adjusted EBITDA improved to a profit of $36 million in the second quarter of this year, compared to $10 million in the second quarter of last year. Year to date, we have significantly improved our year-over-year profitability profile, driven by strong MA plan momentum and a continued focus on optimizing adjusted SG&A. As a result, we've incorporated this first half favorability into our full year outlook to significantly improve our adjusted EBITDA profitability guide for full year 2024. As a reminder, last quarter, we shared that we would introduce a new operational metric to further improve transparency in our insurance performance and to better align with industry standards. This is the insurance benefits expense ratio, or insurance BER. We calculate the BER by dividing the sum of total insurance medical claim expenses and quality improvement costs by insurance premiums. The BER does not affect our adjusted EBITDA calculation in any way, as these quality improvement costs sit within our SG&A. We believe that by also including expense related to enhancing healthcare quality in the numerator of the calculation, we are more accurately reflecting our investment in healthcare quality and member engagement. This ratio better captures the true costs of maintaining and enhancing the quality of care for our members and provides better comparability into our performance versus industry peers. During the second quarter, insurance BER improved to 76.1% in 2024 as compared to 82.1% in the second quarter of 2023. MCR also improved to 71.3% in the second quarter from 77.2% in the second quarter of last year. A strong margin performance was coupled with continued year-over-year top-line organic insurance revenue growth of 11% in the second quarter to $350 million and 10% growth year-to-date to $692 million, driven by strong member retention, cohort unit economics, and a return to intra-year growth outside of AEP. On a year-to-date basis, BER was 79.6% and MCR was 74.5%, both of which represent strong improvements of over 700 basis points year-over-year. During both periods this year, we benefited from the continued maturation of our core MA plan operations and the focus on returning member retention with strong unit economics that Andrew touched upon earlier. We've also experienced prior period developments on both revenue and MedX, both in 2Q as well as on a year-to-date basis, which has depressed our year-to-date BER to lower levels. That said, we expect our BER to be between 81% and 83% for full year 2024 and to land in the mid-80s percentage on a full year incurred basis after normalizing for the aforementioned prior period developments. Of note, our results are still underpinned by elevated IBNR levels. As mentioned during our last call, this was and is due to the Change Healthcare disruption and the transition to our new MA plan ecosystem at the start of 2024. We continue to expect normalization of our IBNR levels by year-end. On the SG&A front, during the second quarter, total SG&A spending was down 4% year-over-year, while adjusted SG&A of $72 million was modestly higher than the comparable period. On a year-to-date basis, total SG&A was down 12%, and adjusted SG&A of $147 million was down 3% as compared to the same period in 2023. Our year-to-date 2024 results continue to include a temporary accounting reserve of approximately $2.5 million related to the increase in claims inventory estimates we flagged during the first quarter as a result of the Change Healthcare disruption and our internal MA plan operational transition. As our processing flexibility continues to normalize throughout the year, we expect this accounting reserve to reverse. Furthermore, both periods continue to see a favorable impact year-over-year from the cost-saving initiatives associated with our new operational ecosystem and our workforce rationalization announced last year, partially offset by increased growth costs driven by strong OEP and SEP growth. Looking ahead, we remain on track to achieve meaningful full-year adjusted SG&A savings versus last year. That said, and in light of our strong adjusted EBITDA profitability performance through the first half of the year and the growth opportunity we now have, we expect to strategically reinvest into our business during the second half of the year to build a foundation for long-term sustainable growth. As such, we anticipate coming in at the high end of our adjusted SG&A outlook for the full year, and we believe that any near-term investment in the long-term trajectory of the business will prove to drive strong returns in the future. Turning to the balance sheet, we ended the second quarter of 2024 with total restricted and unrestricted cash equivalents, and investments totaling $483 million on a consolidated basis, with $201 million at the parent entity and unregulated subsidiary level. Cash flow from operations, excluding discontinued operations for the second quarter, was $46 million, and I am proud that this has improved the company's already strong balance sheet. We continue to expect that our cash flow from operating activities during the full year 2024, excluding the impact from discontinued operations, will be positive. Taking this into account, we continue to expect our year-end 2024 unregulated liquidity to be between $145 million and $165 million. Lastly, and as Andrew mentioned earlier, we have strong conviction that this allows us to operate from a position of strength, and we expect to continue to be able to self-fund growth in the next phase of our business. Additionally, we remain committed to the share repurchase program that we announced in connection with our first quarter earnings. As a reminder, our board of directors authorized the company to buy back up to $20 million of the company's Class A common stock over the next 2 years. Starting in May this year, we began returning capital to our shareholders, repurchasing approximately $2 million of stock during the quarter. We expect to continue to be nimble and prudently manage our capital allocation strategy to maximize value for our shareholders. Finally, I will provide an update to our improved full year 2024 guidance in light of our continued strong business momentum and fundamentals through the first half of the year. We are increasing our revenue guidance for the insurance line of business to now be between $1,360 million and $1,375 million. We are also introducing full year guidance for insurance BER to be within a range of 81% to 83%. As I mentioned earlier, we expect this operational metric to be in the mid-80% range on an incurred basis. We are improving our insurance MCR to be within a range of 77% to 79%. We are maintaining our adjusted SG&A outlook to be between $270 million and $280 million. We are increasing our full year 2024 adjusted EBITDA guidance to be between $50 million and $65 million. As Andrew touched upon, our profitability arc to date is driven by a strong insurance plan performance. We've proven this year that we can deliver significant returns with just a 3.5-star rating, with the opportunity for even better potential results if and when we achieve higher star ratings. Going beyond our MA plans, I'm particularly excited about what Counterpart can add to our performance in the future as we grow our external solution offerings. Counterpart Health continues to garner strong market reception with its robust pipeline. We expect this to only strengthen our ability to execute and improve the company's already strong core fundamentals. In summary, our goal with Clover is to maintain the momentum that we have developed in the last couple of years and continue to improve our business performance. I believe this is exactly what we've done during the first half of the year, positioning us well to achieve our adjusted EBITDA profitability goals in 2024 and improve our underlying cohort economics in 2025 to increase our long-term profitability capacity. Now let me turn the call back to Andrew for some closing comments.
Thanks, Peter. In conclusion, I'm very pleased with our performance during the first half of the year and would like to thank the entire Clover team for their continued efforts in delivering such strong financial results. Before we head to Q&A, let me reiterate the key takeaways of the quarter from my perspective. 1, we delivered positive net income for the first time as a public company and improved our full year 2024 adjusted EBITDA outlook. 2, business fundamentals are strong, with double-digit top-line revenue growth and industry-leading loss ratios. 3, we improved our already healthy balance sheet and believe that we have the ability to self-fund future membership growth. 4, we're well-positioned for long-term growth in Medicare Advantage via our PPO-centric approach. And 5, our strong performance in our own MA plan is driving interest in our Counterpart third-party offerings. Today's results demonstrate that we're able to perform well where others don't. We thrive in fragmented markets, and we don't rely on anchor health systems or value-based contracts. For most MA plans, these are challenging dynamics, but our technology-centric approach allows us to profitably sustain a benefit-rich, wide network PPO plan. We're generating meaningful adjusted EBITDA profitability at a 3.5-star rating, positioning us well for even better results if and when we achieve higher ratings. And unlike almost every other MA plan, we see ourselves accountable for the total cost of care for our entire book of business, as opposed to others who heavily rely on risk delegation and capitation. Our strong insurance fundamentals, coupled with our counterpart offerings, make for an exciting time to be a part of the Clover Health journey. Once again, thank you to everyone, and I very much look forward to providing more updates later in the year as we continue to execute against our goals. With that, let's go to questions.
Thank you, Mr. Toy. Ladies and gentlemen, we will now be taking questions from Clover's research analysts. At this time, if you wish to ask a question, please press star 1 on your telephone keypad. You may remove yourself from the queue by pressing star 2. In the interest of time, we ask that you please limit yourself to one question and one quick follow-up. We'll go first this afternoon to Richard Close of Canaccord Genuity.
Yeah, thanks for the questions. Congratulations on the execution. Peter, I was wondering if you could comment a little bit, just from a modeling perspective as we think about it. Salary and benefits looks like it decreased about $3 million sequentially. And I was just curious if there's anything specific there that drove that, and how we should think about that, I guess, in the second half. Is it pretty much steady state at the second quarter levels? We'll leave it there.
Hey, Richard. Glad to be here. Thanks for the question. Overall, I would say SG&A, of course, we continue to optimize as we scale as well. If you kind of look at quarterization for your own model purposes, of course, there's some seasonality in the fourth quarter as we make investments, both in quality and otherwise.
But nothing specific to the second quarter, why that went down so much sequentially?
Just continued optimization.
Okay. Andrew, maybe as my follow-up question on the home care business, there's been several, I guess, articles out in the journal about home visits and, I guess, questioning the validity of that. I was curious if you could just walk us through the home care business for Clover, what you're doing there, and maybe how it's different than I guess the home visits that are referenced in the journal articles.
Yeah, thanks, Richard. And just on your previous question, I just want to note that, as Peter says, there's nothing new that we're doing. But for year-over-year comparisons on SG&A, we have spoken for several quarters prior to Peter joining as well. I talked about how we were transitioning to a new operating infrastructure with our partnerships. And how we're moving some operations to some partners. And I think that you're seeing some of that effect flow through, just as we discussed about a year ago at this point. So nothing new, but just want to remind everybody that that's us executing upon our plans that we discussed starting from the middle of last year. Regarding the home care and and how we do things differently, I think there's a couple of different dimensions here that I want to emphasize. Number one, we are very focused on looking after the sickest and most complicated within members within the home. And we believe that the home setting is the best place for that. That's why we have in our home care system, we do have nurse practitioners, but we also have MDs, we have DOs, and we are actually taking over primary care for a lot of the folks in our home care practice. So we see the sickest as being looked after from a primary care perspective, and that is our focus, and that's what I discuss a lot. We also do some nursing visits, but a lot of the times those nurses are looking at chronic diseases, making sure that they're being managed properly, and then most importantly, referring into that primary care system. So if we think that someone is getting sicker and they need more close attention, we take over that primary care relationship. And I think that's very different and a very different home care strategy than what you see others basically focusing on. I think another dimension that we should talk about here is that our technology, Clover Assistant and the Assistant platform, brings together the care team between primary care, nursing visits, and to make sure that data is moving back and forth between these various areas. And so when you get a visit from a member of our home care team, our members are all being looked after in the home, but that information and data we also share to any user of CA, and that's available within the interoperability ecosystem in a longitudinal way using Clover Assistant. So I think both those things are very key aspects that differentiate our program from others. As a final note, we are very proud that our home care program has an extremely high net promoter score, and that's something we monitor very closely in terms of whether people would recommend the program to others.
That's very helpful. Thank you.
Thank you, Richard.
Thank you. Thank you. We go next now to Jason Cassorla at Citi.
Great, thanks. Good afternoon. Congrats on the quarter. Peter, can you give us a sense on what the MRA true-up adjustment was in the quarter? And I wanted to double check on the normalized DER for 2024. It sounds like that would be in the mid-80s range, excluding this favorable reserve development. Is that the right baseline we should be thinking about for jump off next year? And then in guidance, kind of would suggest a bit of a steep step up in cost trends in the back half of 24. Just, is there anything kind of outside of normal seasonality or your conservative posturing that you're seeing, and maybe what you're seeing, just maybe just broadly cost trend wise for July? Be helpful. Thanks.
Thank you for the questions. I think there's about 5 in there, so we'll try to answer all of them. As far as DER, like in the prepared remarks, we expect on an incurred basis to be around the mid-80s%. As far as developments in the month of July, we do see more processing of IBNR and paid claims. The volume is picking up nicely in the month of July. And then as far as the adjustment mid-year, I don't think we have previously disclosed that, and I don't think we will on this call either.
Okay, so just to be clear for everyone, just the mid-80s incurred is the right jump off, or are there nuances?
Yeah, we haven't given specific guidance yet for fiscal payment year 25, if you will, but for 24, we expect DER on an incurred basis to be in the mid-80s%. If you pencil it in for total year, yes, of course, it's a jump off point into 25, but I think we want to be clear that we haven't necessarily commented on 25 yet.
Sure, of course. Okay, got it. And then maybe just as my follow-up, I want to make sure I heard this right too. It sounds like you're looking to perhaps spend away incremental upside on MCR for business reinvestment purposes. Just want to make sure, did I hear that correctly? And then, maybe in that context, can you walk us through the unregulated cash bridge for 24? It sounds like you're still keeping that 145 to 165 expectation for year end. Obviously, you had a better EBITDA result kind of year to date than expected. Just hoping you could bridge the cash for us as well. Thanks.
Yeah, thank you so that's 2 questions. So maybe start with the cash first, right? So as for the prepared remarks, we have $201 million of unregulated cash. And if you walk that forward to the end of the year, we have an ACO REACH repayment, if you will, of a deposit of around $39 million. So that gets you to around $160 million of unregulated cash. So we're being a little bit conservative on the second half in the outlook, if you will, but we feel good overall. So that gets you to that range, if you will. As far as investments in the business for long-term profitability and growth, so we're increasing over time, of course, the capacity and the capability of the model to produce increasingly profitability. So you should think about quality investments as well, and system investments, right? And of course, also sales investments over time, but I will stay shy of discussing specifically our sales strategies as we go to market later this year.
Okay, thank you.
Yeah, thank you.
And ladies and gentlemen, just a quick reminder, star one, please, for any further questions this afternoon. We'll go next now to Whit Mayo at Leerink Partners.
Hey, thanks. Good afternoon. I know you don't want to disclose the MRA payment, but I just wanted to maybe understand what's driving it. It seems like you confirmed that you did have an MRA payment, which happens in the second quarter. And was there higher than average favorability in that payment this year?
Yeah, I don't think we disclosed that necessarily.
Okay. Maybe just second question. There's been a lot of industry chatter on the 2 midnight rule, and just curious if you're seeing any noticeable movement there that you can detect. Thanks.
Yeah, we've been following this, Andrew. 2 midnight, like we've been following the rule obviously for a little while. We've always been following the CMS guidance on this. And so I think we've been a little less perturbed by this as others. And so things are basically proceeding as we foresee, no real net impact for us.
Okay, thanks guys.
Just one quick point as well. I think that as we look at all these and as we introduce the various numbers here, we used the MCR before, and a few of you are asking about the BER number here. I think that the idea is that I would note that we are sharing the incurred number into be in the mid 80s, and that incurred number would be obviously not carrying forth any PPD, and so that's why that number will be slightly different than the number in the guidance.
Andrew, can I follow up on one other thing?
Sure.
Just when you talk about July, I'm not exactly sure I follow exactly what you mean by more claims processing. Is this a good thing, bad thing? I mean, maybe just elaborate a little bit more on what you're saying.
Yeah, I can answer that one. So as you saw in the prepared remarks for this quarter, but also last quarter, both because of the Change Healthcare incident, if you will, plus then our switch over to a new provider, the new partner, we have elevated IBNR levels in the unpaid claims, right? So that comment regarding July is really that we see good progress in the processing volume of those unpaid claims. So we expect that balance to further reduce through this quarter and next quarter.
Okay, so that wasn't a comment on utilization. It was a comment on working through the backlog.
Correct.
Okay.
Yes, yeah, working the queues.
Thank you. And ladies and gentlemen, any further follow-up questions today, please press star one at this time.
All right, folks. Thanks for all the questions. So just to reiterate, we believe that we are the only technology-powered managed care company in the market that's aiming to deliver better clinical outcomes, better cost of care, as well as physician choice. Really, we believe that this is the future of Medicare Advantage, and we look forward to continuing to lead in this aspect via Clover's unique tailwinds and technology-powered care platform. Thank you all again for joining our call today, and I look forward to sharing more on our achievements in the second half of the year. Thanks, everyone.
Thank you, Mr. Toy. This concludes today's Clover Health second quarter 2024 earnings call and webcast. You may disconnect your line at this time and have a wonderful day. Goodbye.
Hello, hello, hello. All right, guys, do you hear me? Do you hear me? Do you guys hear me? Am I still muted? You guys should be able to hear me. All right, everyone hears me. Okay. All right, well, a couple things. We'll just basically talk about the negative first. One thing is, I like Peter. Great, pedigree. Very communicative on LinkedIn. Talks about kind of the general advice. My recommendation, Peter, is you just focus on Clover. Don't talk too much about, here, let's just kind of basically, I'm not trying to tell you how to run your life, but when I see someone who is doing all of this postings in regards to, maybe you need to rethink your approach and all of these quotes, I like this. It's great, but I expect you, if you're willing to take on these extracurricular activities, I expect you to do a home run in your presentation skills, and also certainly invest in a better mic. Okay. So because your presentation skills, they weren't really clear. There's a little accent, which is fine. You just have to get a better mic and practice on your earnings. It's your first one, but just some positive feedback. Whenever I see all these posts, I expect you to do a home run on everything. If you're not, stop investing in this and focus on the earnings. Now, you may have a team doing this, but it is in your best interest to do that. And you need a little bit of energy, as what you were saying. Exactly. So, a better mic. Exactly. Come on. It's a hard time understanding you. Okay. So now we got that out of the way. Okay. Number 2. Thank you. Another thing is that in regards to the medical reimbursement arrangement plan, there are some issues regarding with that, and some posturing and some anonymity and just some undisclosure of information was in this call. And I think Clover Health is like, you know what? We're tired of giving you extra information. We are in the battle of these incumbent competitors. You see the information. You see what we posted. This is enough for you to come to your own conclusion. So I like that, right? They're in the upper hand now, and analysts can just take it for what it is. Okay. So there's that. I just wanted to comment on that since it's just happened. Number 3 or 4 or whatever. The next bulletin point. Repurchase of common stock. This is it doesn't say. I don't know if this is a number in terms of in thousands of dollars. It seems as they're in dollars. So I think 1.7 million shares was purchased for whatever million amount of dollars, maybe $2 million. I'm not too sure. But regardless, approximately less than $2 million or $2 million was used out of the 20. I need to look at it a little deeper. Why is this positive? Okay. Well, one is that we still have $18 to $17 million left to buy back more shares. That's good news. Also, every time they buy back new shares, it formulates a artificial bottom of a stock, because retail investors are going to be like, well, if Clover is buying at these prices and they're going to continue buying at these prices, then why am I selling? Why am I selling? So it's a nice little strategy. Okay. After hours now is 193. Okay. Now, of all the posturing you heard on on Wall Street, dumb money has sold and smart money is buying. And we've been saying this for the past how many years, and this is kind of an example. Okay. So individuals that took advantage of this dip today were heavily rewarded. Now the question is what's going to happen tomorrow? I talk about that in our research edge and our technical edge, part of our stock terminal, monthly subscription, and or lifetime access. So if you guys want that and everything we have to offer with 2.5 billion outputs of data, financially, institutionally graded data. There'll be a link down below, coupon code SAS to get $1,000 off, which will be expiring soon. Take advantage. Now, in regards to, what the hell is this? In regards to, the chat's so funny sometimes. In regards to the intrinsic value, I left off before the earnings call started. So I did the intrinsic value and I did 11% at 0.05% of estimation of future free cash flow of the high end benchmark of $1.375 billion. I went ahead and inputted that into the estimation average of free cash flow and went 10 years into the future and discounted back at a 10 to 15% discount rate using a 2 to 3% perpetuity model divided by the number of outstanding shares. By doing this, I got a bear case of $1.91, a base case of $2.47, and a bull case of $3.39. Now, Andrew Toy, and this is the next level I want to talk about, he specifically stated that this is not including the revenue for Counterpart Assistant. The success of our Medicare Advantage PPO plan of a record approximately 71% MCR rate is making other healthcare insurance providers come to Clover Health to get access to their AI-driven platform, the Clover Assistant and or white blanketed Counterpart Assistant. And he specifically said that the revenue aspects of that is not yet being added into the upper end of the revenue for the guidance of this year, meaning that we could potentially see more positivity in the future, right? Meaning that we have more surprises and partnerships and all the in between to be announced in the future. Okay. So there's that. Now, with that said, if you look at the average estimation of free cash flow of United Healthcare and Humana, you get around 7%, which is around, sometimes a little higher. This is a non-SAS-like calculation of Clover, but it's just a kind of estimation of future free cash flow in that arena. Okay. If we were to use 7%, we get $96.25 million in estimation of free cash flow. We use the 11% growth rate in which they grew now. You get a bear case of $2.67. Now, why is the bear case of $2.67 important? Well, if you go ahead and go here, it is right around the resistance line here. So regardless, if we, obviously in a bull case of $4.75, which is almost $5 in bull value, right? So regardless if we are 5% of estimation of free cash flow, we know the revenue is going to grow up and we're going to return to growth. The upside is anywhere 339 to 475, not including SAS and not including this increased upside that what we're expecting. So regardless of how we cut it, the company is still undervalued. Okay. And all the hard work that we did, we were the only people on YouTube talking about Clover Health. We're the only people that have been doing an intrinsic value calculation. We got attacked, we got laughed at, but guess what, ladies and gentlemen? Who's laughing now? We are laughing ourselves all the way to the bank, right? While the naysayers are basically going to be flipping our burgers when we go to Las Vegas. Okay? So anywho, this is pretty much the analysis. Again, if you want the more full analysis and everything we're doing, price targets and all the other stocks, data, you can look at our Mastering Stock Market course. I believe that we have now proven ourselves with everything we've been saying, that this is the right way. This is the Warren Buffett way in which we are teaching. And our results speak for themselves on our platform, which I stand 120% behind. Okay. Now, in closing, we should talk about just vary this really quickly. We could just kind of scroll through this really quick. We talked about everything. I like this one. PPO plans are better. Patients decide where they want to go. It's increasing in terms of the popularity. And Clover is profitable on a PPO adjusted basis alone, which is very good. New SaaS coming in. So we're going to be expecting to see that. There's a nice pipeline for that. And they are $7 million in GAAP net income, which is great because once they're full GAAP full year, you're going to see a lot more institutions coming in. Okay. And I agree, it is an inflection. Okay. So yeah, that's pretty much it, guys. We can go a little bit more in detail, but we're going to save that for our Insider Stock Terminal because I got to go. But overall, I think this was a very successful phone call. Peter needs to work on his presentation skills. But other than that, it's been pretty real with you. If you haven't done so, please hit that like button and don't forget to subscribe. I'll see you on the next one. And don't forget to check out our coupon code down below to join our wonderful, highly intelligent group of intelligent investors around the world. Thank you for your time. See you on the next one.